Ladies and gentlemen, welcome to this other session of Kurga Tariq Finance and Accountancy tutorial. This is an extension or a continuation of our previous session on adjustments of final account. Just a recap, we say that some of the adjustments of final accounts of a trader are depreciation. Number one was depreciation. Yes, we looked at depreciation. The link is attached below in the comment section. You will see our explanation on that other session that was talking about depreciation accounting. Then number two, we talked about the provisions of bad and doubtful debts. Again, ladies and gentlemen, the link to this session that we are talking about the provision of bad and doubtful debts is attached here under in the comment section. And then the third one was accruals and prepayments. Accruals and prepayments. So this was the third one. And then the fourth one was drawings. Today we are going to look at the accruals and prepayments, and I'm going to combine it with drawings because drawings don't have too much to discuss in this area. Drawings has got very little adjustments. Ladies and gentlemen, before we continue, why don't you subscribe to this channel if you are not subscribed, and make sure you hit the notification bell so that you don't miss out on any tutorial that I post, and make sure also that you like this video and you share it with your network so that they can also benefit from this free tutorial. So you like and you share. It is important for us to understand that the modern accounting has migrated from cash accounting to accrual accounting. So this is the migration that is taking place now. We are going to check on the two elements in our dealer word. Do you still remember our dealer word? Dealer word. When you divided by two, these were drawings, these were expenses, and these were assets, right? The other side, liabilities, equity, and revenue. So when I talk of the two elements in our dealer word, I mean the expenses and revenue. Revenue is the same as income. Yes, so that is what we are going to measure in our accruals and prepayments. So before we look at these expenses and revenues, it's very much important for us to understand this. When you are given this in the additional information, the accruals and prepayments adjustment, you are being tested on the accrual concept of accounting. The accrual concept of accounting. The accrual concept of accounting. And this is how it goes. The accrual concept of accounting states that expenses are recognized when they have been incurred. They have been incurred and not, let me write this in capital letters, and not when they have been paid. Right? I will explain this. And then again, this is for expenses. So for incomes are recognized when they have been earned, and not when they have been received. So the key words here, let me write this one in capital, very, very important. So the keywords here are paid, received. And so these ones also should be written in capital. And yes, so the incomes are recognized when they have been earned and not when they have been received. Those are the keywords. Expenses, on the other hand, are recognized when they have been incurred. These should be in capital letters. Incurred. Yes, so that is one term. And not when they have been paid. Full stop. So ladies and gentlemen, look here. Remember, we are talking about the expenses and incomes, right? So this is what accrual accounting, or the accrual concept of accounting, or the accrual basis of accounting means. That expenses are recognized when they have been incurred and not when they have been paid. So let's take a very small example here, that maybe me, now I paid electricity bill. Electricity is an expense. An electricity bill of Kenyan shillings 5,000. And then the bill for the month, the bill for the period was Kenya shillings, let's say 10,000. Kenya shillings 10,000. Yes. So what this is trying to say, what this part of the definition tries to state, is that the expenses are recognized when they have been incurred. Do you know how much we incurred as an electricity bill? We incurred 10,000 shillings. But we paid 5,000 shillings. Right? So in the income statement, or according to the accrual concept of accounting, we recognized what was incurred, the total incurred, what was consumed by electricity, and not what was actually paid. Are we together? So in the income statement, this is what will happen. In the income statement, you will take the full incurred of 10,000, so to be compliant to the accrual concept of accounting. And then in the balance sheet, yes, so this is where I normally use my Kiswahili language, which is a little bit understandable. You can use even another simple language. That in the balance sheet, you will take the difference being 5,000, right? Yes, when you less this one, the difference is 5,000. Remember, you have not paid for the 5,000, and you are supposed to have paid. You incurred 10,000, but you paid 5,000. Meaning the electricity company, or the power and lighting company, will requires you to pay an extra 5,000. So this one is a liability to the business, right? So it's a liability because you have not paid. In Kiswahili, this is what we say: kitu yangu is an asset. Kitu ambayo sio yangu is a liability. Right together. Kitu yangu is an asset. Kitu ambayo sio yangu is a liability. Good. So this 5,000 is not mine. It is the power lighting company's money. So the company have to pay the 5,000. It's a liability. So in Kiswahili we say kitu 5,000 sio kitu yangu, so it's a liability. Are we together? So in the balance sheet you take 5,000 as a liability. Are we together? And then this one, the 10,000, you take it as expenses in the income statement. So ladies and gentlemen, that is what I'm trying to explain in my first portion of the accrual concept of accounting definition. So let's move now to this other section of income. So this one was the electricity bill, which is an expense. So let's look at an income, so that we try explaining this other part of the accrual concept of accounting. So let's say dividend Dividend income received was Kenya shillings 5,000, but total dividend for the period was Kenya shillings 10,000. So how do we go about this one? Let's go to our definition. Incomes are recognized when they have been earned, and not when they have been received. And in our case was 10,000. But what was actually received was 5,000, meaning we did not receive 5,000, right? We did not receive the 5,000. According to this one, the incomes are recognized in the financial statements when they have been earned. We earned 10,000. So meaning in the income statement, under incomes, we are going to recognize the full figure of 10,000 because that was actually what was earned, 10,000. And then in the balance sheet, you take the difference. The difference is 5,000. 5,000. And what are you going to call it? Let us think it together. Let us think it this way. That we were supposed to receive 10,000, but we received 5,000. Meaning that company that maybe gave us the dividends income, they still have our 5,000. That our 5,000, our means it's ours, and that thing that is ours is an asset. In Kiswahili we say kitu yangu. So this 5,000 is kitu yetu or kitu yangu. That's why we are calling it an asset. Kitu yangu is an asset, right? So this 5,000 is going to be treated as an asset in the balance sheet or in the statement of financial position. And then the 10,000 is what is going to be recognized as incomes in the income statement. So ladies and gentlemen, I want to believe I've done justice to the definition of the accrual concept of accounting, right? With that very, very example or illustration. Accruals. Accruals have the same meaning as outstanding. Outstanding. Outstanding means not paid or not received. Another name for accrual or outstanding is in arrears. Another name of the same, of in arrears or outstanding, is owing. Owing. Yes? So, my friends, in the additional information, or when you are given an additional information in an exam setting, so, and then you are told that maybe electricity bill accrued or this amount of money, outstanding this amount of money, in arrears this amount of money, owing this amount of money, or not paid, all these terms means one and the same thing as accrual or accrued. They mean one and the same thing. Make it so simple. If you understand Kiswahili, make sure and learn kitu yangu is an asset. Kitu ambacho sio changu is a liability. Kitu yangu is an asset. Kitu ambacho sio changu is a liability. Let's go. Let's sing together. Kitu changu is an asset. Kitu ambacho sio changu is a liability. Great. Let us now look at the accounting treatment of accruals. Remember, we are adjusting on the final accounts, and these are the adjustments we are doing, accruals and prepayments. So we started with accruals, good. So let us now look around, or rather see how you treat these accruals in the financial statements. When I talk about the financial statements, the balance sheet, the statement of financial position, and the income statement, right? So I gave you an example. That you paid electricity bill, paid was 5,000. This is expense. Yes. And then what was incurred was 10,000. So there is still that 5,000 that is not paid. So it's a liability. Sio kitu chetu. Are we together? sio kitu chetu. Kitu ambacho sio chetu ni liability. So that 5,000 we need to pay. So it's a liability. So in the balance sheet, if it's an expense, accrued expense is a liability. Are we together? Accrued expense is a liability. So look here. Okay, if you have the statement of financial position, I want to believe you remember the format, right? So you have the current liabilities. So that part of current liabilities. There, you will say, if it's accrued, if it's electricity bill, you will say accrued electricity bill of maybe 5,000, because that is what is accruing at that time. So that is how to do. So this is just an extract of the statement of financial position. So under the balance sheet, you indicate the accrued expense as a liability. Are we together? Then we move now to the income statement. The income statement takes what was actually incurred expense. If we incurred 10,000, this is what will go to the income statement. Are we together? Because that is what we actually incurred. Remember from the definition, the expenses are recognized when they have been incurred. So they are recognized in the income statement when they have been incurred. They are all 10,000. The 5,000 will go as a liability in the balance sheet. Good. So this one was about expenses. Now, what about the incomes? Yes, the incomes. So in the incomes, this is what happens. Incomes in the balance sheet. In the balance sheet, I told you, an income is what you receive. Yes, here is what you receive from that other person who is giving. If it's rent income from the tenants, right? And you imagine that the amount that you earned as far as, okay, in terms of rental income was maybe 10,000 Kenya shillings, but what actually was paid by the tenant is 5,000, right? So you can go to the tenant and tell him or her, please give me my 5,000 that is remaining. No. So that 5,000 is your thing. It is your money. So that's why it will go to the balance sheet as an asset. As an asset. Yes? In Kiswahili we say kitu changu. That 5,000 from the tenant is kitu changu. Na kitu changu is an asset. Kitu changu is an asset. Please recite this one more often. Kitu changu is an asset. My thing is an asset. That doesn't belong to me is a liability, right? Good. So in the balance sheet, it will be an asset. So this is how it will look like. So let's assume this is still our balance sheet extract. So under current assets, you will say accrued rental income, or let's say accrued income of maybe 5,000. That is how to do. We have treated it in the balance sheet as an asset. And then we come to the income statement. What do you think will be done here? The definition of accrual concept of accounting. That incomes are recognized when they have been earned. We earned the full figure of 10,000 as rental income, not what we received. So the full value, that is what was actually earned. Yes, that is the full figure. If you actually earned 10,000 as rental income, but you received 5,000, what you are going to record in the income statement is the full 10,000 what you earned, right? And then the balance or the deficit will be treated as an asset in the balance sheet. We are done with accruals. We are done with this one. We are done with accruals. So we are remaining with prepayments. So prepayments is totally opposite of the accrual. So let's look at it. Prepayments. So let's look at the first part, as expenses. So we can either prepay expenses or or incomes. So let's look at prepaid expenses. Prepaid expenses. Paid in advance and prepayments are the same thing. Are we together? So another name of prepayments is paid in advance. Right? So another name of prepayments is paid in advance. It was paid in advance. Are we together? Prepaid expense. Prepaid expense. A prepaid expense or an expense that has been paid in advance, yes, is an asset to the organization. I know you're confused. Look here. Maybe you are told that the incurred rent, maybe you are paying rent. The incurred rent was 10,000. But what was actually paid is 15,000. Yes, prepayments or paid in advance means you pay in excess of what you are supposed to pay, right? It is the opposite of accrued. Accrued means you did not pay to the point of what was actually incurred. But in a prepayments, you have paid in excess of what you are supposed to pay, right? Isn't it? Good. So here you incurred 10,000, but you paid 15,000. So what does it mean? You paid in advance, you paid in excess 5,000. That 5,000 that you paid in excess is your money. You can go back and tell that person that you paid the money to, please bring back my 5,000. That my 5,000 is what? Is an asset, sindio? That 5,000 ni kitu yangu. Kitu yangu is an asset. Yes, kitu yangu is an asset. So that means in the in the balance sheet, you are going to treat this as an asset, right? So in the current asset section, you are going to say prepaid rent expense of 5,000. Yes, it's an asset. You can go back and take it. Ni kitu yangu, an asset. And then in the income statement, what do you do in the income statement? According to the definition of accrual concept of accounting, in the income statement, you take what was actually incurred. We incurred 10,000. So you are going to take 10,000 as an expense. Yes, what was actually incurred. Are we together? Tunaelewana, si ndio? Good. So that is how to treat the same in the financial statement. So in our example here, what you are going to take as an asset is this 5,000. Then what you are going to take to the income statement is this 10,000. Period. So let's look at prepaid income. I know by now you now understand if this prepaid income is kitu yangu, my thing, an asset, or a liability, kitu ambacho sio changu, isn't it? So let's look at an example. I like using examples. So you're supposed to, okay, we earned dividends of Kenya shillings 10,000. Yes, from maybe a certain circle. The dividend income was 10K that you earned for that period. But you received, the circle maybe gave you 20,000. Remember you earned 10K, but the circle gave you in excess by 10, right? It gave you by 10,000. Remember, even it is negative. Yes, it gave you in excess by 10,000. Are you able to treat this one in the financial statements? Comfortably say, look at it this way. I was supposed to earn 10,000, but I'll be given 20,000. Yes, so meaning the 10,000 extra is not my thing, it's not my money. So it's a liability. The circle can come for their money. In Kiswahili, this 10,000 sio kitu yangu, ni kitu ya sako. Yes, kitu ambacho sio changu is a liability. Answer, a question answered. So in the balance sheet, you are going to say the balance is going to be treated as a liability. Yes, that is the 10,000 is a liability. And then in the income statement, you are going to take what was actually earned. The what was actually earned here is 10,000. Period. That is how to treat the same. So ladies and gentlemen, that was all about the accruals and prepayments as far as the adjustment for final accounts of a sole trader is concerned. If you have any question, feel free to interact with me in the comment section, or you can contact me via the contact details that I have provided in the start and at the end of each and every video tutorial. So our last adjustment is drawings. That was number 4, was drawings. There is not much about drawings. Yes, we all know that drawings normally reduces capital. That's why you'll find in the balance sheet or the statement of financial position, under the financed by section, financed by, we normally say capital a certain figure, and then we less drawings. Yes, and then maybe we add net profit. Yes, that is what we were saying. So now we want to see how to complete the double entry. Remember, the capital in the trial balance has already gone the double entry rule of accounting. But if you are given anything to do with drawings in the additional information, it means that you need to do to make it compliant with the double entry by passing the necessary entries, right? So there are 2 types of drawings. Yes, so number A is stock drawings, and number B, cash drawings. Yes, so stock drawings, this one is kind of the sole trader is eating the stock. Eating that stock means it will reduce the stock of that organization, or rather that sole trader business organization. And remember, stock is what you purchase so that you sell. So meaning, when you stock draw, when the sole trader does the stock drawings, it means he is affecting the purchases account, right? So in short, the purchase account is going to reduce. So under, this is how to treat it. We said when we are opening the income statement, under the cost of sales, we are saying the opening stock, yes, you add purchases, yes, these purchases, now you less the returns outwards on the purchases. And then since there is stock drawings, this is how to treat it in the income statement. This is the income statement. Yes, you less stock drawings. Yes, so that you arrive at that very figure that you're going to tick at the side, so that you get the total goods available for sale. Then you further less the closing stock, so that you arrive at the gross profit. Yes, so in the income statement, the stock drawings are going to reduce the purchases. These are the purchases, that's why we are lessing the stock drawings here. That is how to treat the stock drawings. Are we together? Let us see how we can play about the double entry rule of accounting. Let's talk about stock drawings. Stock is purchases. So let's open the purchases account. I want us to be so practical. And then we have capital account. Purchases account or stock accounts. This one have got debit balances. So let's say the balance brought forward of stock is a certain figure. And then the balance the capital normally has the balance brought forward on this other side. But we are drawing stock. Drawing stock means we are reducing this purchase account, and it is also affecting the capital. So yes, so you're going to say the drawings on this side are going to reduce, and also drawings, you can decide and open the drawings account. Yes, and you complete the double entry. This one is credit. This one will come on this other side, purchases. But let us bring it here so that to use to be particular as far as our statement of financial position is concerned. So this one is credit. So meaning to complete the double entry, we are going to bring to this other side of debit of the purchases that figure that was actually drawn. Is that clear? The same case applies to cash. Let's look at cash. Cash account. Cash account. Cash account has got balance brought down in the debit side. When you draw cash, you are going to draw on the credit side to reduce this balance. And then to complete the double entry, this credit, you bring it to this other side of the capital account, the debit side. So that is how to treat the stock drawings and the cash drawings. In short, that is how to adjust for the final accounts of the sole trader as far as drawings is concerned. So ladies and gentlemen, thank you so much for your time, and welcome again in our next sessions. But if you are not subscribed to the channel, please do so. Thank you so much. May God bless you, and until next time, it's goodbye for now. Subscribe.